All right. Pleasure to welcome back to the Medics Money podcast. You're becoming a bit of a podcast favorite, I have to say, Steve. I get like really good reports about your podcasts. Mr. Steve Nichols from Nichols & Co., specialist medical accountants.
All right, well, that's lovely. That's great to hear, Tommy. I'm pleased people enjoy the podcasts. Often we do get people who get in touch with us and say, look, I heard you on the podcast. They found it informative, and they often want to have information on particular aspects, nearly always to do with limited companies and directors' loan accounts, but not always. So that's great. I'm pleased people enjoy it and find it interesting.
Yeah, and today I'm excited because we're basically hitting 12 or more of the most common questions that you get asked by people that listen to this podcast and then ask you questions.
No, these aren't the most common questions, Tommy. These are things I've dealt with in the last couple of months. So I get asked an awful lot of other questions more common than these, but I've covered all that in my other podcast. So I thought I'd just say, look, these are sort of interesting questions. At the bottom there, I've got a few things I would just cover, which I've covered before, which are the things I'm always asked. And so I thought, well, I'll just cover those anyway, because they're always of interest.
Love it. Okay, buckle in. Now, if you're watching on YouTube, last time Steve was on, he was wearing a very nice Hawaiian shirt. Steve, today, I'm guessing you've got a client meeting, and it might be an important client because you're looking pretty smart today.
Yeah, I've got a big client, but I'm going on holiday. I'm going scuba diving next week, so I'm going to be in the Hawaiian gear next week, I think. As long as I'm going to... Anyway, so yeah, I'll be in the Hawaiian gear, but you're right. I've got a big meeting at 1 p.m., yeah.
All right, we better get going. That's a very nice tie. That's very well tied as well. It looks pretty serious. Okay, so question number one. Are more doctors moving to Dubai?
Right. Well, this is something that I thought I'd mention because we do a lot. Over recent years, probably over the last 3 or 4 years, we deal a lot with people moving, full time to Dubai, but not particularly doctors. I mean, and we do everything that they need, all the taxes. We can get visas and residency permits and help with the medicals and everything, even pick you up at the airport if you want when you go over there to do your medical. But I've never really had doctors get in touch with me and ask me about that. But in the past couple of months, I've had a few, and I thought, well, blimey, maybe this is a thing that's happening. Obviously, there are great advantages from a tax point of view going to the UAE, Dubai, Abu Dhabi, wherever it may be. The doctors that we've dealt with, obviously, they don't need a lot of the services we do because they've already got their work sorted out over there. But what we've helped them with is really the tax to make sure, obviously, the great advantage of going there is there is no income tax in the UAE. And so you can go over there, live tax-free. Obviously, it's pretty hot now until September, I think. So as long as you can put up with the temperatures, terrific. And lots of people like it out there. I mean, in the past, we've had lots of solicitors and bankers and people going out there, but maybe it seems doctors are going there as well now. And where we help people going out there is just make sure, what I say is if you are going out there, for heaven's sake, get someone to advise you properly on the tax. It's quite complicated. People normally want to spend 90 days back in the UK, which you can do that and still remain non-resident for tax. They want help with the number of working days you're allowed to do in the UK. I don't know how much you know about the non-resident tax, but what they really want is just somebody who can say, look, I've checked your situation. If you're going to spend these days in the UK and these days working in the UK and the rest of the time out of the UK, you're going to be non-UK resident. You won't have to pay any income tax. The other thing I'd say is very often, obviously, we do thousands of income tax returns each year. But if you have simple tax affairs, listen, you don't need an accountant. You can do your own tax returns. Very good software online. Do your own tax return. But don't try and do your own tax return if you're looking for split year treatment or non-resident treatment. The tax return pages are very difficult to get right. The questions they ask do not mean what they appear to ask. So what I'm saying is if you are one of those people who's looking to go abroad, for heaven's sake, make sure you get someone to help you with the tax and particularly with the tax return and the number of days you're going to be in the UK. Because you only have to be in the UK for 91 days. You've lost your non-UK, you've lost your non-resident status and bang, your income from Dubai is now taxable in the UK. So just watch out for that. I was surprised. I've never had any doctors ask me about that before, but the past couple of months I've had a few.
Yeah, I mean, lots of doctors I know have gone to Australia, New Zealand, Canada, even had a doctor who went to America on the podcast. Check that out. How to Get to America as a Doctor has an awesome episode with Nawaz. But yeah, I guess like Dubai's logical step. So if it's too hot in the summer in Dubai, yeah, just come back for the English summer, and I guarantee you will cool down, like guaranteed.
Yeah. So we've always had lots of, as I say, solicitors and bankers, but in particular, all sorts of people going out there. But I don't know. Just the past couple of months, doctors. So I just thought I'd throw that in as you know, if you are somebody who's thinking of doing that, for heaven's sake, get some proper tax advice and make sure you get the benefit of the, you know, no tax in Dubai situation.
And I think that illustrates a wider point, like a founding principle of Medic's Money, is that there's so much that you can do yourself with the right information, which hopefully we provide here. But at some point, you have to draw the line. And as Steve said, this is where you draw the line. Like, you just need expert advice for this. So good tips. Okay, next question is about money box companies. So before we answer this, should we just briefly define what that is? And then it might be topical, but should I liquidate it before the election?
Okay. Well, a money box company, I've spoken about these several times, and what they are really is where somebody has sufficient private earnings in a limited company to not have to take those earnings out of the limited company. And so they can build up money in a limited company, and we'd call that a money box company. And what the typical thing that people would do is when they finally retired, stopped private practice, and don't actually have to retire, they just have to stop private practice, they could then liquidate that company, take all of the funds out, and pay tax on that capital distribution at 10%. And that tax rate was compared very favourably. If they were an additional rate taxpayer, which they often would be, they'd be paying tax maybe at just about 39% on a dividend. So there's a big saving if you could take the money out as a capital, claim business asset disposal relief, and pay tax at 10%. So that's great. Now, what I've had in the past 3 months, I suppose, before the election was announced, really, people were saying, look, they're worried about taxes after the election. I mean, there's been a lot of talk in the press, I think in the past few days, actually, about the rates of capital gains tax going up. And so what we've had is doctors saying, well, look, I'm going to stop doing the private work now. I'm going to effectively retire from private practice, and I'm going to take my money out now and get my 10% business asset disposal relief. And that's that. And so we've had people retiring early or finishing private practice early in order to take advantage of these tax rates. Now, that does make sense. I mean, if you have enough in there, I think one guy had, say £1 million in there, roughly, approximately. So he was going to put, I think it was actually a husband and wife, they were going to pay tax on that at £100,000. And that compares to nearly 400,000 if it was treated as a dividend, or if they had to pay tax at a higher rate after the election. So, it might be, I don't know when the podcast is going to go out, it might be too late to do anything, but certainly I'm seeing several people now, I don't say a lot of people, because lots of people, can't just stop private practice, but people who can and have thought about it have come to us for advice and said, look, can we do this? And we said, yes, you can. And so we've done several of those in the past, 3 months, where people have retired early, taken the money out, banked there, if you like, business asset disposal relief at 10%. And so I just thought that was interesting. It may, by the time this podcast goes out, unfortunately, it might be too late to do anything about it.
Yeah. Is that, just forgive my ignorance, I've not really been following the election. Is that because Labour is proposing to end entrepreneurs, well, it's not called entrepreneurs relief now, is it? But what you called it, essentially entrepreneurs relief.
Yeah, well, essentially entrepreneurs relief. Well, they haven't said that. No, they haven't specifically said that. I mean, I think the only thing they've said about capital gains tax is we're not going to put capital gains tax on people's homes. But I think they are. I don't think tax rates are going to get any better. They're only going to stay the same or go higher. So where people have been a bit nervous about that, about thinking, well, the rate's only going to go up, if they're getting to a situation where they were going to retire in a couple of years anyway, they've said, well, look, I'll just retire now. I'll bank my tax at 10%. Then whatever happens after the election doesn't matter because I've banked my tax, and that's the end of it. So I don't think Labour have said they're going to end entrepreneurs relief, no. But people have thought, well, maybe they will. I mean, entrepreneurs relief has changed a lot over the years. You used to be able to get 10 million quid's worth of entrepreneurs relief. Now you can get £1 million. So, I mean, there has been a lot of talk about them increasing capital gains tax, but I haven't heard any talk specifically to do with entrepreneurs relief, no.
Yeah, okay, I see that. Like, lock in the certainty of today and avoid the uncertainty of tomorrow. And if you're going to do it soon anyway. Yeah, okay.
Yeah, sure.
Yeah, I was just wondering what was driving it, but now I've thought about it. I'm like, yeah, okay, I get it. One thing that I think is in a manifesto is VAT on private school fees. So tell us about this.
Yeah. Well, this has been talked about in the press for months and I don't know how long, for a long time. And just recently, we've had several clients ask me, look, is there anything we can do about this? And what they were thinking about is you've always been able to pay your fees in advance for private schools. So if you have enough money, perhaps you want to make sure your grandchildren go to private school and the education is paid for, whatever happens, you could always go ahead, you get a small discount, not much of a discount, and you could pay your fees in advance. And so what the opportunity that was sort of highlighted was, well, look, can I pay my fees in advance today before the election and avoid the 20% VAT increase, which Labour are going to put on private school fees after the election? And so there was, a bit of discussion about whether this would work or whether it wouldn't. I think now it's probably quite unlikely that it's going to work. There is sort of a precedent in the past. I think when George Osborne introduced VAT changes way back, again, he said, look, you can, I'm putting these VAT changes in, but if you do things to sort of artificially, try and avoid the VAT, we're going to bring in these anti-avoidance provisions, which were called anti-forestalling measures, and we're going to get the VAT anyway. So I think what would happen is if Labour got upset about it, they'd just say, look, it doesn't matter when you paid for the VAT. If your child's getting educated this term and the VAT rules are in, we want you to pay the VAT anyway. So it's sort of a nice try, if you like. People have tried and thought, how can I get around this VAT? But I think it's now quite unlikely that you're going to be able to do that. So obviously you could pay your fees in advance anyway if you want, because you would get a slight discount, but not much of one. I think probably you'd be better off leaving your money in if it's paying 4% in a bank account and paying them as you go. But I don't think, certainly I'm advising clients that I don't think that's going to work if people do pay the fees in advance.
Many other tax efficient ways to pay school fees, primarily relying on having wealthy parents or grandparents, as they would be. But yeah, okay, good info. Shall we move on to what is a stipend?
Okay, I thought I'd just cover this because this really applies to people who are doing things like researchships. And often they're not terribly well paid, and often they're paid by a stipend rather than a salary. And a stipend really is just a payment to somebody, really to defray expenses rather than a salary. It's not an employment contract. I don't know. I think it's sort of a bit of a historic anomaly, if I can say that word. And the thing about it is they're not taxable. So if you do, I think it's because they are often quite a bit less than a salary. And so if you're doing a research fellowship or something like this, and I think this applies in Australia as well, it's not just the UK, and you get a stipend, you might think, oh, blimey, I'm not getting much here. It's tough doing this, but you won't have to pay tax on it. So again, I hadn't really come across that before. I was asked a query by a client not long ago, and so I thought I'd just mention it to everybody. If it comes up, stipend, ask your accountant, say, look, is this taxable? Probably, probably isn't if it is properly a stipend. And so I didn't know that, so I thought I'd just mention it to people. If it comes up, at least check with your accountant, see if it's taxable.
Yeah, good info. Awesome. Next question, I'm guessing is anonymous from a slightly shady client maybe. Is a bank fraud detectable for corporation tax?
All right. So this wasn't a client who was carrying out a bank fraud. This was a client who was hacked and had money stolen from their account. And actually, I made a mistake on this. So the client said to me, look, this has happened. I was hacked. He explained how it had happened. And they took quite a large amount of money from the bank account. And I think he's going to get most of it back now. But he said to me, look, if I don't get it back, well, presumably I'm not going to have to pay tax on this. He's earned profits. It's been stolen or hacked. Will I have to pay tax on it? And I must say, at first, I thought he would. Because in some circumstances, when that happens, you do have to effectively pay tax on money that's been stolen. But he wasn't happy about that, and I researched it. And, basically, if it's down to a bank error, which I believe it was in this case, then if he doesn't get those funds back, then he won't have to pay tax where he's been hacked and money's been taken from the bank. Now, everybody may say, well, blimey, of course you shouldn't have to pay tax on that. But, well, I don't think that's the case in all circumstances. But where you've been hacked and there's a bank error, you don't have to pay tax, or this was a limited company in this case, you don't have to pay corporation tax on funds that have been stolen from you. So that's all that was about. Again, I just thought I'd mention that. I hope it doesn't apply to anybody, but if it does, you don't have to pay tax on it.
I feel bad because I assumed the worst when I read that question, but actually, apologies for assuming the worst there. But also a rare case where common sense and humanity also mirrors the tax law. So,
yeah.
All right.
Okay.
We get tons of questions about this, and I know you do. But essentially, should I insure myself by insurance against a tax inquiry?
Right. Well, I think obviously it's not necessary. I was asked the other day actually by a new client, do I have to insure against a tax inquiry? Well, no, you don't have to insure against a tax inquiry. I think it's a good idea. I always recommend it to all clients. And what I was going to say about that is if you do take out tax protection insurance, make sure it's a proper scheme. I know some schemes which are competitive. If you do have a tax inquiry, you can't use your own accountant to deal with the inquiry. It's dealt with by an accountant effectively appointed by the insurance company. And that accountant's brief is normally to get this inquiry sorted as quick as you can, and most people these can be very stressful circumstances. People can get really upset. And, if you then have somebody who, perhaps you don't know, perhaps doesn't know you dealing with the inquiry, it's not always ideal. So, I always say try and get a good scheme where you can get the person you want to deal with the inquiry dealing with the inquiry. I think the other thing to say is you can have an inquiry for no reason. it's not necessarily your fault. There's not necessarily anything wrong. Now, I think that's getting a bit rarer these days because I often say to clients, look, they ask me about tax inquiries and I say, well, normally we can predict the people who are going to have tax inquiries because, we know there's something technically difficult about their tax return or they've made a big entrepreneur's relief claim or whatever. So, but you can have them for no reason. And all these insurances do is just level the playing field. Because although the revenue haven't got unlimited resources, they've got more resources than me and you. And if they want to, they can stick at an inquiry, even if there's not much in it for them. And, it just levels the playing field and gives you a bit of peace of mind. And one inquiry I'll just quickly mention, if I may, we were dealing with this. I think it's nearly finished, but it's still ongoing. It's nearly finished, though. A chap took 24-hour retirement years ago. 6 or 7 or 8 years ago. Obviously he's still working in the GP practice. He's drawing his pension. And he had enhanced protection. So that was I don't know how much you know about this type of thing. That was enhanced protection. So he could not have any lifetime allowance charge. And in fact, that was good because his pot was way over the lifetime allowance. Now, the NHS Pensions Agency look at that when you take your pension and they check, is there a lifetime allowance charge? And they said, no, there's no lifetime allowance charge. They knew about his enhanced protection. They said there's no what they call relevant benefit accrual. And that was all fine. The revenue have come along. I don't think they really understand what they're talking about, if I'm honest. They're asking all sorts of questions which indicate that to us. And it's really worrying for this guy. He's thinking, well, what's the problem? I retired 6 or 7 or 8 years ago. I've now got this revenue inquiry. What are you talking about? And, and if he did have a lifetime allowance charge, it would be hundreds of thousands. Because he was way over the lifetime allowance. So, he's in a fortunate position because he's still a GP partner in a practice. He has tax protection and we can go to, the absolute experts on this and say, look at this pension, confirm there's no relevant benefit accrual, confirm the enhanced protection is not withdrawn, confirm there's no lifetime allowance charge. Now, try doing that on your own. That's pretty difficult to try and work that out on your own. And, we've gone back to the revenue and they've said, yeah, okay, there's no lifetime allowance charge, we admit. But at least he's in a situation where he's got people who can do quite a lot of work, which is necessary, can go and get expert reports on it and get it sorted out. So, I always say there's nothing unusual about your tax, or if you're doing anything, for example, whenever we have a money box company and we'll say, right, we're going to take this money out at 10% and do this and do that with a director's loan account or something, we always recommend to the client, look, get tax protection insurance, because if it's looked at, we can just chuck £150,000 at a tax barrister and we can argue your case and, we'll win it. And it's for a modest cost. if you're saving hundreds of thousands by getting a 10% tax instead of a 39% tax on a dividend, you can afford a modest amount of insurance just to make sure if there's any issue, you can just throw an expert at it and get it sorted out. So I just mentioned that case. It's the sort of thing, that's a bit of an unusual case, but it's the sort of thing that can come up. And people who have tax inquiries always want to insure next year, because once you've had an inquiry and been through it, one, it's expensive, but it's not even that. It's so worrying that people always insure once you've had an inquiry. So I would say if you're unsure at all about your tax, have a word with your accountant and they'll be able to advise you on this sort of insurance.
Yeah, I think like my general overarching principle with insurance is that I don't insure anything that I can afford to replace, right? And I think most people do the opposite, right? So I don't insure my phone gets stolen, I just buy a new one. I don't insure my washing machine, I don't insure my TV, but anything that I cannot afford to replace, like me, I have income protection, I have life insurance, I would insure against. So I think, yeah, if you can't afford to replace it easily, consider insuring it against it. And I think it's like a good thing. Once your tax affairs get to a certain level of complexity, you got to be thinking about this, definitely.
I think the other thing I'd say, Tommy, for a GP practice, I think this chap that I was talking about who took 24-hour retirement, I think he's got 4 or 5 partners. So effectively, if his partnership is insured, that insures him as an individual as well. And I think it also insures his spouse, actually. I can't remember. I think it does, yeah. And, the cost of that, once you split it between 4 or 5 partners, so, is quite modest, actually. And so I think for every GP practice that we work for, they all have this tax insurance cover. Makes absolute sense, and it's not a huge cost. It's very worrying and upsetting if you have a tax inquiry, and particularly, actually, it always seems to, the hard inquiries these days for GPs does seem to be around their pensions and things like that. So they're quite technical. They're not sort of, have you claimed, too much mileage on your car, which isn't really a very technical thing. So, yeah, so I pretty much recommend it.
Awesome. Good sage words and a sage example. I like it. Next question. What is a relevant life plan? Can I have one and should I get one?
Okay, well, this again, something I was dealing with for a client, I think 2 weeks ago. His IFA had got in touch with me and said, look, he needed some information from me because this client wanted a relevant life plan. And I thought, yeah, okay, well, I hadn't particularly thought about relevant life plans before for doctors, but it makes sense. So a relevant life plan is relevant to somebody probably who has private practice and is trading through a limited company. So it's probably going to be somebody with private practice in a limited company. And what a relevant life plan is, it's term life cover. So if you need term life cover, you do it through a relevant life plan. I'll tell you why you would in a moment. But you might say, well, what is term life cover? Why would I have that? Well, let's say you have a mortgage and it's not a capital and interest repayment mortgage, so the capital balance never goes down, but you want to cover it until the day that your mortgage ends, and you then have to repay the mortgage. You'd have to repay the mortgage. Presumably you're saving separately to repay the mortgage, or perhaps you're going to repay it out of your lump sum when you retire. So you want to cover your mortgage for a term, let's say maybe 10 years, and and that's fine. That's very common. It's not an unusual situation at all. You've probably got, I would imagine, if you were just chatting about your insurances before, I imagine you've got mortgage insurance to cover your mortgage. And it will be probably term insurance if you've got a interest-only mortgage, and probably decreasing term if you've got a capital and interest mortgage. So if you want term insurance, it's very common to do. So that's all that a relevant life plan is, really. It's just term insurance. And what it's designed for is to be a sort of a death in service benefit for directors of a limited company. And so if you're a director of a limited company with your private practice in a limited company, why not take out a relevant life plan to pay your term insurance? Right. So you may say, why on earth would you do that, Steve? Why would I do that? And this is why you would do it. Let's say you had a mortgage, and let's say the premium in a year was £1,800. So if the mortgage was big enough, the premium could easily be £1,800 a year. Okay, if you pay that through a relevant life plan, this is how the tax works. You earn £1,800 in your limited company. You pay the premium of £1,800. End of story. There's no tax. You get a corporation tax deduction for the relevant life plan. You do not have any benefit in kind. If you make a claim on that policy, it will be written in trust, and your dependents will be the beneficiaries, of probably the trustees and the beneficiaries of that trust. So it's exactly like normal term insurance if you make a claim. The difference is it's paid from pre-tax income. So you earn 1,800 quid and you pay 1,800 quid out. End of story. Now, if that term insurance is paid by you personally, this is how it works. You earn £3,750 and then you pay corporation tax on it of about £750. That leaves you £3,000 in your company. You then take a dividend that you pay nearly 40% on. That leaves you £1,800 in your hand. So it's cost you over £1,800 to get £1,800 in your hand to pay the term insurance. So that's why if you're looking for term insurance, you might want to consider a relevant life plan. And as I say, it doesn't cover it. You can't use it for decreasing term. You can't use it for whole of life. But if you need term insurance, you should probably be asking your IFA to consider that. So I don't know if I explained that properly, but any queries on that one, Tommy, please?
It makes perfect sense to me. The only thing I would just say is that definitely find a reputable IFA to do this, because there are a lot of, I don't know, I think there's a few scams around in this area. So get a decent IFA to sort that out for you in conjunction with your decent accountant as well.
I'd agree with that, yeah.
Because you live in a bubble, Steve, where you're expert and you only work with other experts who you've known for years and years. Outside that bubble, people are running Facebook ads and YouTube ads and they don't look 100% legit. Maybe that's unfair, but yeah, just bear that in mind. Okay, next question, kind of a technical, procedural one here. Why is opening a bank account so difficult for consultants that are trading through a LLP?
Right. Well, several consultants who trade using limited liability partnerships. And the reason for that is, say the consultants might be providing services as a group of consultants to a trust or to a private hospital. Trading through an LLP is a very good way to do that because of the flexibility. So if one consultant does, 50 hours a year, he or she is going to get paid more than somebody who does, 20 hours a year. So LLP is a very good legal entity for flexibility. Also, again, people's own tax planning. You can have your own limited company can be a member of an LLP, or you can individually be a member of an LLP. So they're very flexible. It's very common for groups of consultants to work through LLPs. So I thought I'd just give this tip because this is a real life case. It was a nightmare for us. We had a group of consultants in London who wanted to work together in an LLP, and I think there were about 35 of them. So they tried to open a bank account, and the bank said, well, hang on, we've got to do money laundering on 35 people. And it was a nightmare. To get 35 people to give the documentation to the bank was difficult. And once sort of 34 had given the documentation, and then the 35th, who was out of the country or something and didn't get back until 3 months later, gave his documentation, all the other documentation was out of date. So they had to go back and do it again. It was a nightmare. And, just a nightmare. It's like this... banking is so difficult now, isn't it? Like, as Nigel Farage found. But, it's difficult to do all this anyway. So eventually they said, what are we going to do? We've got to get a bank account. So what we decided to do was we closed down their LLP and open up a new LLP with 2 members. You've got to have 2 members of an LLP. And it was much easier to money launder 2 members of an LLP. Open the bank account. And once that was all happened, and I checked this out with a bank and they were happy with it. And I said, look, this is what we're going to do because we just can't get through the money laundering procedures. They said, fine. So we opened up another LLP, appointed 2 members, got the money laundered, got the bank account open, and then another 33 members joined after that. So that's just a very practical tip. I mean, not relevant for everybody. But if you're a group of consultants wanting to start up trading in an LLP, for heaven's sake, get your bank account sorted out before everybody joins and you have to get 35 people money laundered.
In a surprise to almost no Medics Money podcast listeners, basically it was really difficult to get a load of doctors to submit really boring paperwork on time, and that was the problem there. Yeah, in a surprise to no one, we're not the best with paperwork. All right, This is something that we've been banging on about for absolutely ages. It is still a big problem. It's become an even bigger problem now because of the recently announced consultant pay rise, which of course is a good thing. You know what I'm going to be saying here. The £100,000 cliff edge tax trap from hell, where the money is just sucked out of your account faster than it goes in. What can you do about it?
Well, there's only really two things you can do about it. I mean, it always hits home to me when people have got, quite a few, several children, and they're getting the tax-free childcare. Perhaps they've got nursery care as well. And you go over the 100, you lose that, so that's a huge amount to lose. Then you start paying tax at 62%. If you've got superannuation deductions being made as well, it's just a nightmare. And there's only really two things you can do. One, you can make a pension contribution. Again, probably the most practical way to do is not to go into the NHS scheme, but just because it takes so long and it's administratively quite burdensome to do additional pension contribution. But just go into a SIP or something, make a modest contribution to a SIP, get your net income to 99,000, and avoid the tax trap. I mean, that's a practical thing to do. But you've obviously got to keep looking at your income if you're getting near there. Secondly, the other thing is gift aid. I mean, obviously you're giving away money to charity there, but with gift aid, obviously you can make gift aid contributions in the year that we're talking about, in the tax year we're talking about. But you can also carry back gift aid. So if you went over in 23, 24 and thought, heavens, what am I going to do? You can make a gift aid payment in 24, 25 and then carry it back. So that's nice that you can carry that back. You're not having to sort of look at so if you make a mistake and you're, £101,000, you can say, well, hang on, I'll make a gift aid contribution of £1,000 in retrospect and carry it back. Now, you can't do that with a pension. You can't make a pension contribution in retrospect, but you can with gift aid. So again, I don't know how many people are aware of that. Obviously, lots of people are aware of the £100,000 trap. I don't know how many of them are sort of aware of the practical ways to deal with it. One is to make a SIP contribution, but you've got to do that before the end of the tax, or not necessarily a SIP, a private pension contribution. You can do an NHS, you can buy additional NHS pension, but it's just administratively cumbersome and difficult. And if you want to do it quickly before the 5th of April, probably the practical thing is just, do a personal contribution. Or if you do miss the 5th of April deadline, do a gift aid contribution, in the next tax year and then carry it back to the previous tax year.
Yeah, and a lot of people get confused about adjusted net income here. And if it seems as well that sometimes HMRC might be getting a bit confused about it as well. On our Medics Money Wellbeing course, we have an awesome spreadsheet that you just put your income into. It works out what your adjusted net income is, because that's what we're talking about with the £1,000 thing. And then it shows you, models how, if you put £1,000 in a SIP, how that goes down and stuff. Because in some ways, this is an amazing problem to have. That is an amazing amount of money. But, the tax you pay has to incentivize you doing work. And in this area, around the £100,000, if you lose your tax-free childcare, you're paying 62% tax, plus, your student loan, superannuation, pension, if applicable. The marginal tax rate can be up to like 80% or something crazy. And then it disincentivizes work. Like, a sensible tax system should incentivize work and make everyone pay a fair amount. And this seems a bit counterintuitive, but you can do loads about it, but you got to do it. So if you're in that area, either come on our course, speak to Steve, or be really sure that you know what you're doing. And then also, if you do a SIP, you're like, well, how do I set it up? What do I do with the funds? How does it work? How does the tax relief on the SIP work? How do I put that in my self-assessment? So it is complicated, and we take you through all of that as well. So yeah, check out, you're coming on our course, Steve. I'm so excited. It's medicsmoney.co.uk/courses, the wellbeing course. The next cohort starting in October, but you're coming on the first cohort really soon, which is pretty exciting, because we're going to be talking about all of this and more, like advanced tax planning.
Yes, that's right. I know I'm going to cover a lot of the things, particularly on limited companies, on how you can use those to keep tax reduced, about spreading income around the family, about directors' loan accounts, which I'm asked about all the time, the flexibility they provide. I think there's going to be more and more of that if we have a Labour government and tax rates go up. Going to talk about paying private pensions out of limited companies, salaries out of limited companies. What's the difference, salary or dividend out of a limited company? These are things I'm asked all the time. So yeah, I'm looking forward to that. I think that's in July, and yeah, all good.
I hope you're ready for a ton of questions, because we have a really active online community of doctors that are on our courses there. And the other question I want to know, is it going to be a shirt and tie sort of day for you, or is it going to be Hawaiian?
No, I'm definitely going to wear my Hawaiian. I'll probably get a new Hawaiian shirt. Maybe orange, I don't know.
Love it. Okay, next question. Can my spouse become a partner in my GP practice?
Okay, so this again is something actually my business partner, Shanmir, was working on. We had a client and, they had a nice problem in a way. They were a couple of GPs and they were earning a lot of money, but they got fed up with certain aspects of that. One, they got fed up paying 45% tax on a big part of their income. And they got fed up because they were caught by the taper on the pension. They were getting massive tax charges. So they said, right, well, hang on, we're going to come out of the NHS pension scheme, which they did. And then they asked us to look at this, and they said, look, what can we do? And we thought about all sorts of different things. And what we came up with, or we didn't, I think we came, I wouldn't say we came up with it, they suggested it, we looked, can you do that? And in fact, they had a very well-known firm of solicitors looking at the contract and making sure that everything was being done properly. They wanted to introduce their wives as partners into the GP practice. Now, the wives would be working for the GP practice. One was actually a doctor and one was an HR expert. And so the wives did do work for the GP practice. But why they like the idea of introducing them as partners rather than, let's say, as employees, which might be more normal maybe, was one, they weren't going to pay employers NI. Two, the profits, it's very unusual for the revenue to query a profit split. If you employ somebody, then really you get a deduction, and if they're connected to you, so if they're a family member, then the revenue might look at the amount of pay that they're getting and they say, is this commercial for the work that they're doing? Well, they're much less likely to look at something like that if they're looking at a profit share. I don't think I've ever really had a profit share queried by the revenue, and they generally don't look at partnership profit shares very much. The other reason why they were keen to have the spouses come in as partners was, of course, they'd be part of the NHS pension scheme and they'd be able to make NHS pension contributions without getting the tax charge. Now, they were getting the tax charge because their incomes were so high and they were getting caught by the taper. But the incomes of the spouses who were going to come in and become partners were not going to be caught in the same way. So the spouses were introduced as partners. They had quite significant profit shares, I think maybe £99,000 each. And so when you look at the family, the household savings there, they were going from 45% tax to maybe 40, 20 and zero tax. So the saving there, I think, is about £17,000 a year for each partner. The spouses were able to make pension contributions into the NHS pension scheme, which weren't being taxed. They weren't getting caught for tax charges. And so it achieved a lot of what the original GP partners wanted to achieve. And so I thought that was quite an unusual thing, which I think we have come across that once or twice before. But it's quite unusual, and it worked quite well from a sort of financial planning point of view. So they were able to save income tax, quite a lot of income tax, able to make pension contributions without having a tax charge, and were able to, avoid, employers' NI in particular. So that was interesting. I mean, I think if people want to do that, it's important. Look at the contract properly, get some legal advice to make sure that's okay. And of course, the spouses who come into the partnership do have to work for the partnership. So that was an interesting one, but it worked out quite well. And I thought it was quite an unusual one that people might like to hear about.
Yeah, I think it is unusual, but it outlines a wider concept. But of course, you got to take specialist advice if you're thinking about doing that. Don't just do it because you heard it on the Medics Money podcast. Do it yourself. But the wider concept that it illustrates, which is really important, is to consider tax as a family. And this is something that we go on about on the Medics Money Wellbeing course. That if you consider tax as a family, which is exactly what these people have done, then you can, utilize your allowances at a very simple level. It is far more tax efficient for two people to be earning £49,950 each than it is for one person to be earning £100,000 each. It's just far more tax efficient at a simple level. I mean, is that something that you talk about this with your clients all the time, I'm sure?
Yeah, yes, you're absolutely right. I mean, that's one of the reasons that limited companies are great, because you can split income across the family. So, I mean, that's a way of saving income. I mean, again, it's nothing wrong with that. The revenue, the Inland Revenue never attacked that. I think they did attack it about 25 years ago in the Arctic Systems case, and they were told, no, this works from a tax planning point of view. It's absolutely, what you call it, it's nothing fancy. All accountants are advising this. Everybody who has the opportunity to advise properly does this. It's not considered to be tax avoidance or anything. It's just considered to be careful tax planning, and it's quite acceptable. I mean, we would never do anything that's considered to be beyond the pale or outside the sort of, don't quite know how to, acceptable tax planning. Certainly, splitting income across family members using a limited company or a partnership. Sometimes we use partnerships. Is what's the phrase? It's just absolutely sensible. Why wouldn't you do that?
Yeah, I mean, it just seems like something that you do every day, but I still bump into so many people who are not considering their tax position as a family, if relevant, if you've got a family. So, yeah, there's just so many allowances and reliefs that you can spread out as a family, not just tax-free childcare. That's the one that everyone thinks about, right? But there's just way more depth to it than that. Okay, this next one is like asking for a friend, right? What should I do if I've forgotten to pay tax on my buy-to-let property income?
Okay, well, this happens all the time. I mean, this happens with doctor clients and other clients as well. For whatever reason, people become landlords. Perhaps accidental landlords is the phrase that's sort of used. Where they, perhaps get married and hang on to their flat that they originally had before they got married. That's very common, and they rent that out. And then for some reason, they don't declare the rental on their income tax return, and it can build up over a couple of years, and then people don't like to think about the problem because it just gets out of hand. And I don't know how many of these do them all the time. But if you are in that situation, then it's okay. One thing you can do is nothing. Well, the problem's not going to go away. It's just going to get bigger and sort of become an issue in your mind. Perhaps you worry about it. Or you could come and see somebody like ourselves and go into what's called the Let Property campaign. So that's a way of declaring rental income that the Inland Revenue have set up, particularly for landlords who've forgotten to declare their income. You can come along, particularly if you come along unprompted. So that's without the revenue telling you to come along. And you can say, look, I've had this income. I've got to declare it on my tax return. You do it all online. You don't have to go in and talk to a tax officer. There's no grilling or anything like that. It used to be in the old days, but not anymore. So you can go in, you or accountant, if you wish, can make the disclosures online. We can say, look, I've had this rental income. I forgot to tell you about it. I owe this tax for these years. Now, if it's an unprompted disclosure, the benefit you get there is that there will be a penalty, I'm afraid, is modest. So the penalty might be 10% of the tax. If it's an unprompted disclosure, that's very common to get a 10% penalty on this sort of thing. Now, if you have an unprompted disclosure, so if the revenue catch you out and say, hang on, you haven't paid your tax on your rental income, the penalty is greater than that. I mean, it can be very high. It's unusual for it to be very high, but it's certainly, 30 or 40% wouldn't be uncommon for an unprompted disclosure. Depend on the gravity of it and all sorts of different things. So all I thought I'd do is just mention that if people didn't know about it, just because there are an awful lot of landlords out there, for whatever reason, have forgotten to put the rental income on the tax return. And if they want to make a clean breast of it and get it sorted out, that's the thing to do. You want to go and talk to your accountant about making a disclosure under the Let Property campaign. This has been around for a long time. I don't know how many, at least 15 years, I think so, or 10 years anyway. So if people don't know about it and they've got that issue, you want to make a clean breast of it, that's the thing to do.
Awesome. Hopefully good news for someone there, and good niche tax knowledge, which we love. Steve, that was awesome. Of course, if people are on the course, they'll catch up with you there, medicsmoney.co.uk/courses. Steve's going to be on the wellbeing course. Where do we find you? Isn't it nichols.co.uk?
Yeah, that's our website is www.nicholsmedical.co.uk. So you can see anything you want to see about us on there.
TikTok? You still on TikTok?
No, I haven't done TikTok for a while now. No, I don't know why.
You went viral on TikTok.
I did go viral on TikTok a long time ago. Yeah, I don't know. I mean, I've sort of stopped. I did have TikTok on my phone, and it's just such a waste of time. I mean, I can't believe me going through TikTok, looking at all the pictures and all the nonsense on there. I mean, it's rubbish. It's just a time waster. So I've taken off TikTok. I don't do TikTok. I think we're on Instagram, Facebook, and on our website. Our website's the best place to find out about us. And of course, get in touch with us through Medics Money. Your website as well, Tommy, is very easy to get in touch with people like ourselves if you want to.
Yeah, just the best of the best on Medics Money, and no one else, no hangers on. Amazing. Thanks, Steve. Really looking forward to your session live on our course where we can grill you about all of these things that you talk about: electric cars, directors' loans, limited companies, all the other things that we talk about in the past. And so that will be awesome. Take care.